with strong momentum. A demand zone is an area where institutions previously bought aggressively, causing the market to move upward with strong momentum. When the market retraces back to a supply or demand zone and gets rejected from it, it creates a potential trading opportunity. The idea is simple. You look to sell from supply zones and buy from demand zones. This is the US dollar versus the Japanese yen on the daily chart. As you can see, the market is clearly trending downward, which means we only want to focus on selling opportunities in the direction of the trend. Now look at these areas on the chart. This is a bearish institutional zone, and this is the next bearish institutional zone. But instead of focusing on both zones, we are going to focus on the most recent one because it is stronger, fresher, and also the closest zone to current price if the market retraces upward. Now pay close attention to the way this zone was created. Look at these large bearish candles. This first candle shows aggressive selling pressure, and the second candle confirms strong bearish momentum continuing into the downside. This type of explosive move is not usually created by random retail traders. It often reflects institutional activity, which is why we call this an institutional footprint. Now also notice something very important. The previous support level was broken with strong momentum, and liquidity was taken below the lows before the market continued downward. This adds extra confirmation that sellers were in control of the market. And before entering any trade, we always want to evaluate the risk-to-reward ratio. Look at this setup. As you can see, the trade offers at least a 3-to-1 reward-to-risk ratio, which means the potential reward is significantly larger than the amount being risked. Now look at what happened next. The market retraced back into the bearish institutional zone, and once price reached the area, an inside bar pattern formed. This pattern signaled a temporary pause in momentum and provided a precise entry setup within the zone. Now here is how the trade was executed. The entry was placed below the low of the mother candle. The stop loss was placed above the zone and above the high of the mother candle. The target was set at the next key support level. This type of entry allows the trade to activate only if the market confirms bearish continuation by breaking below the inside bar pattern. And look at what happened next. The market broke below the inside bar setup, activated the sell position, and then continued moving downward until it reached the target exactly as expected. Now look at another chart example. This is the British pound versus the US dollar on the daily chart. As you can see, the market moved downward, reached this level, and reacted strongly upward, creating a clear support level. Later, the market retraced back to the same area, briefly broke below the support level, and then quickly reversed back upward. This is a clear liquidity sweep.